Here's a question for you. What would you do if you owed $26 billion and instead of going bankrupt, you found a way to screw over the people you owed it to? Because most of us, if we're behind on credit card, we call the bank, we might beg a bit, or we start cancelling subscriptions that probably should have ended with the free trial. We're not calling Jamie Dimon. I'm going to go out on a limb and assume that most of us don't have that option and the rest of us don't know who he is. But this company did. And what they did next shouldn't be possible. And the fact that it is tells you everything about how this system really works. Today, I'm going to go deep, real deep, into the world of distressed debt. What it is, how it works, who profits when companies implode, and the story of one French-Moroccan billionaire who decided when his back was against the wall, it was time to go nuclear. This is the distressed debt playbook. Right, let me introduce you to our main character, Patrick Drahi. He's born in Casablanca, Morocco, son of two maths teachers, gifted with numbers from childhood. Apparently, at the age of 11, he was marking his parents' students' homework. So he moves to France as a teenager, gets into the most elite engineering school in France, École Polytechnique. It's basically the Oxford of engineering, but with more arrogance, if that's possible. He then graduates, gets a job at Philips, gets bored almost immediately, and decides the corporate ladder, it's just not for him. So, early 90s, he starts laying cable television wire in small towns in southern France. Just him and a mate going around convincing local mayors to let them dig up the streets. In a way, you kind of have to respect the hustle. So he builds those companies up, sells them, but, and here's the smart bit, he doesn't take cash. He takes shares in the buyer instead. So now he's sitting on equity in a tech company right in the middle of the dot-com boom. Those shares go up and up and up, and then, this is the move, he sells right before the crash, walks away with 40 million euros. Impeccable timing. And everything you need to understand about this story comes down to what he does next. So in 2002, he starts Altice. And his philosophy is very simple, very aggressive, and as it turns out, very dangerous. Borrow money to buy things, cut costs, extract cash. Use that cash to borrow more money, buy more things, repeat. It's like flipping houses, except the houses are billion-dollar telecom companies and the mortgage is $60 billion. So he moves to Israel, and by 2015, he's the richest person in the country. He owns France's second biggest mobile operator. He's got cable companies across Europe. Sotheby's, the famous auction house, yeah, he owns that too. And then he buys Cablevision in New York, rebrands it Altice USA, now Optimum, for $17.7 billion. At his peak, Forbes had his net worth at $26 billion. By 2026, Bloomberg has that figure down to $7.7 billion. Now, let's be clear, $7 billion is still an obscene amount of money, and I'm not asking you to feel sorry for the man, but look at what that drop represents. And then look at the share price at his US cable business since it listed, down about 95%. Meaning if you were a regular investor who bought in at IPO, you've lost almost everything. Drahi still has his billions. His shareholders, not so much. But before we get too carried away with Drahi, I also need to introduce you to some other folk. Now, you can't have a drama without an antagonist, or in this case, a group of antagonists. Enter the creditors. These are the people that Patrick Drahi and his company Altice borrowed money from. We're talking about Apollo Capital Management, BlackRock, Ares Management, Oaktree Capital, Golden Tree, PGIM, which is Prudential's investment arm, and yes, JPMorgan Investment Management. Now, obviously, these are not small operators. These are some of the biggest asset managements and credit funds on the planet. So these lot formed what's called a creditor cooperative, a formal agreement where they'd act together, move together, vote together on any deal. This is something creditors are increasingly doing in the modern financial market. Now, if you think about it from their perspective, that's sensible. You've lent billions to a company that's struggling. You want to make sure that you're not playing against each other. You want coordination. But from Altice's perspective, it felt like a cartel. And then there's JPMorgan Chase, the largest bank in America and arguably the most important player in this whole story. So those of you who have been paying attention will notice that JPMorgan were already in this. They were already one of Altice's creditors with skin in the game. But they were about to make a move that would shock the entire financial world. Distressed debt is debt that is trading significantly below its face value, typically when the market believes the borrower is unlikely to repay in full, usually defined as bonds yielding 10 percentage points more than US Treasuries or trading below 80 cents on the dollar. Okay, before we get back to the drama, I need to give you some tools. And I know this is the bit where people usually switch off. Don't. Because this is exactly how people make money when companies start collapsing. So, distressed debt, what is it? Okay, imagine your mate Dave borrows $1,000 from you. You got an IOU, says he'll pay you back in 5 years with interest. 2 years in, Dave loses his job. Things aren't going great. He kind of starts missing payments. That IOU still says £1,000 on paper, but realistically, you're not selling that to anyone for $1,000. You might get £500 for it just to get something back. Now enter a third person, Vinny the Vulture. Vinny buys that IOU for £500. Now if Dave recovers and pays back the full £1,000, Vinny just made 100% profit. If Dave goes bankrupt, Vinny still has a legal claim on whatever Dave owns, so he still might recover more than the £500 he paid. That's distressed debt. You're buying the debt of a struggling company at a discount, betting that you'll get back more than you paid. And the people who do this for a living? They're sometimes called vulture funds. Not the most flattering name, I know, but once you understand how this works, you'll see why. Creditor hierarchy is the legal order in which creditors get paid when a company goes bust. Senior secured creditors are first in line. They have collateral backing their loans. Junior unsecured creditors are last. Equity holders, shareholders, get whatever's left, which is usually nothing. Now, here's where I need you to lock in, because when things go wrong, this is the only thing that matters. In the world of corporate debt, not all lenders are equal. There's a queue. Think of it like a nightclub. Some people are on the VIP list, they get in first, guaranteed. Others are general admission. And some people are standing around outside in the cold hoping for the best. So, at the top of the queue, the VIPs, you've got secured creditors. These are lenders who have specific assets backing their loans or pledged as collateral. If the company goes bust, they get first dibs. They might lose a bit, but they usually get most of their money back. Now, behind them are the unsecured creditors. They're owed money, but there's no collateral. They get paid after the secured guys. And right at the back of the queue, shareholders, the actual owners of the company, they get whatever's left, which in most cases is nothing. Now, and this is the key. If you can move yourself to the front of that queue, you win. And that is exactly what JPMorgan is about to do. Covenants are legal conditions written into loan agreements that restrict what a borrower can do, e.g. limits on taking on more debt, selling assets, or paying dividends. Covenant-Lite loans have fewer restrictions, giving borrowers more flexibility but less protection for lenders. Now we need to talk about covenants, and this is where the loopholes live. When you lend someone money, you don't just hand it over and hope for the best. You put conditions on it, rules. So let me break this down for you. Imagine you lend your friend £20,000 to start a business. You might say, oh, you can't take out any more loans without telling me, or you can't sell the business without paying me back, or you need to show me your accounts every single month. Those are covenants. Now, in the corporate world, they're written into loan agreements that run hundreds of pages. In a strong market, when money is cheap, borrowers have power. And for years, big companies have been getting what are called Covenant-Lite loans. So fewer restrictions, fewer guardrails, more freedom. It sounds great until things start going wrong. Because you see, those same loose contracts, they create loopholes. And those loopholes can be used against you. Lender-on-lender violence is when a distressed borrower working with a majority group of its lenders restructures its debt in a way that moves new, super priority debt to the front of the queue, effectively subordinating and wiping out minority lenders who weren't part of the deal. So, this is where it stops being finance and starts being war. I'm talking about lender-on-lender violence. Here's how it works. You've got a struggling company, it needs to restructure, maybe raise new money, maybe extend its debt. But not all lenders agree on what to do. So the company finds a majority, say 2/3, and cuts a side deal with them. In exchange for helping, those lenders get something better. They swap their old debt for shiny new debt that sits right at the front of the queue. Super priority, first in line. The minority lenders, the ones who weren't invited to the side deal, they wake up the next day and they've been pushed to the back of the queue, from first class to economy overnight. Their debt might now be worth pennies. That's lender on lender violence. It's controversial, it gets challenged in court, but in the US, if the contract allows it, it's allowed. Now, remember earlier, that creditor group that Altice was fighting, the whole point of that cooperative was to stop this exact thing from happening. It was a defensive move, but Altice had a card they didn't see coming. So let's set the scene. It's late 2025, and at this point, this company is running out of options. Altice USA, now rebranded Optimum Communications, is drowning. $26 billion of debt, interest rates are up, the cable business is bleeding customers to streaming, revenue's under pressure, and the debt is still there. And there's a specific urgent problem. They have this $1 billion loan that they got in the summer from Goldman Sachs and a fund called TPG Angelo Gordon. Now, that loan came with some pretty aggressive terms, which meant they were effectively locked out of borrowing from their existing lenders. And now there's a clock ticking. What's known as a call protection period was about to kick in, meaning if they didn't refinance soon, they'd have to pay a premium, possibly as much as 16 cents on every dollar. Now, that doesn't sound like a lot, but on a $1 billion loan, that's $160 million penalty. So at this point, they've got a problem, and none of their existing lenders want to help. So they make a move that nobody saw coming. Actually, let me rewind slightly, because before we get to January, we need to understand what happened in November, because November is where things go from bad to completely unhinged. So Altice goes around their own lenders. They raised $2 billion directly from JPMorgan to refinance a different loan that wasn't even due until 2028, 2 years early. But here's the devastating part. This new JPMorgan loan was secured using collateral that had previously been available to protect existing creditors. So in simple terms, JPMorgan jumped the queue, and everyone else got pushed back. Their new loan sat above everything else in the creditor hierarchy, senior secured, top of the VIP list. Moody's, the credit rating agency, put out a note that basically said, the legal protections that investors think they have can vanish in an instant. The safeguards investors relied on evaporated overnight. The existing creditors, Apollo, BlackRock, Ares, the whole cooperative were furious. And then, the very next day, Altice files a lawsuit. Now, just pause there for a second, because this is insane. A company that owes billions is now suing the people it borrowed the money from. In federal court in Manhattan, Altice USA, now going by Optimum Communications, sues 9 of its own creditors: Apollo, BlackRock, Ares, GoldenTree, JPMorgan Investment Management, Loomis Sayles, Oaktree, PGIM, and one more. And they don't hold back. Their exact words in the complaint, and I love this, are, quote, "The cooperative is a classic illegal cartel. Competing debt investors have agreed to lock Optimum out of the credit market unless Optimum offers terms the entire cooperative deems acceptable. It is also classic price fixing." They argued that this cooperation agreement bound nearly every creditor holding their debt and required 2/3 approval before any individual firm could do a deal. They said this violated federal and New York antitrust laws. Now, this is extraordinary. This is a borrower suing its own lenders for antitrust violations in the middle of a restructuring. It's a bit like if you owed a mortgage to 6 banks, couldn't make your payments, and then sued all 6 banks for colluding to not let you remortgage. Except, of course, there's $26 billion at stake. I told you, this is Shakespearean. And then January rolls around. Remember the Goldman Sachs and TPG loan that's about to trigger the penalty period? JPMorgan steps back in. They provide another $1.1 billion to Altice to refinance that loan at face value before the penalty clock starts. Why would JPMorgan do this? So there are 2 theories. Theory 1 is the fee income. It's enormous, right? Banks like JPMorgan charge significant fees for this kind of deal. When there's a $1 billion transaction, even a 1% fee is $10 million. And this deal is significantly more complex than that. Theory 2, and this is the one that was reported by the Financial Times, JPMorgan believed that if they didn't lend, the private credit funds would. So this wasn't just a loan, it was a defensive move. They weren't just helping Altice, they were protecting their own position. And those funds would use different legal structures that would move Altice's most valuable assets even further out of the reach of existing creditors, including JPMorgan, who was already a creditor. So in other words, JPMorgan made the calculation, better to control the deal than to be excluded from it. If someone's going to move up the queue, better it be us. Think about it like this. Do you remember in The Wire when Omar went around and he was stealing drugs and then selling them back to the drug dealers? I guess in his mind, he feels like, well, it's better that he does that than the police seizing the drugs and taking them completely out of circulation. Well, needless to say, the financial world was stunned. Not because JPMorgan had acted, but because a bank of that size had gone directly into territory that had for years been reserved for specialist distressed debt funds. They'd crossed a line that banks had quietly agreed not to cross. Other creditors called it betrayal. Industry veterans said no bank had ever so directly run over their partners in a lending consortium. And then Altice, having just received its second JPMorgan lifeline, turned around and sued JPMorgan Investment Management as part of its antitrust case. The very firm whose parents' company had just saved them twice. Now, here's the bit they don't tell you. This doesn't just affect billionaires. This story is a window into part of the financial system that most people have never heard of, the private credit market. So over the last decade, as banks have been more heavily regulated following the 2008 crash, enormous amounts of lending has migrated out of the traditional banking system and into private credit funds. Apollo, Ares, Oaktree, these aren't banks. They don't have depositors to protect. And they are now some of the most powerful lenders in the global economy. And most people have no idea how much power they actually have until something like this happens. This is also what happens when the system gets pushed to its limits, when a borrower and lenders go to war, when the contract terms, those hundreds of pages of covenants become weapons, and when a major bank decides to break ranks with the private credit world it had always supported from the sidelines. And finally, and this is the only one that really matters for ordinary people, Altice USA is also known as Optimum, and it's one of the largest cable and internet providers in the New York area. It has millions of customers. Whatever happens in this debt restructuring, whether Altice survives, sells, or collapses, will have real consequences, because behind all of this, it's not just numbers on a screen, it's people's internet, people's bills, people's jobs. And depending on how this plays out, a lot of people are going to lose, and most of them won't even know why. Right, let's bring this thing home. A quick recap. So, distressed debt. This is how people make money when companies are falling apart. Creditor hierarchy, there's a queue, and whoever gets to the front of it wins. Covenant-Lite, great when times are good, dangerous when they're not. Lender-on-lender violence. This is where the majority rewrite the rules and the minority get wiped out. And the Altice story. $26 billion of debt. A billionaire who built an empire on borrowing, a group of creditors he called a cartel, and a bank, JPMorgan Chase, that decided to break the rules and move itself to the front of the queue. And this thing, it's still playing out. And this is why I always say the real action in finance is never where they tell you it is. It's not in the headlines, it's the contracts. If you want more of this, I'm on TikTok and Instagram, same name, breaking these stories down as they happen. And if you rate what I'm doing and you want to support it, you can buy me a coffee. The link's below, and it helps me keep going, keep digging, and keep explaining this madness properly. I've read the news so that you don't have to. I'll see you next week.